Hey, it's Frank. It's July 28th, 2023. It's Friday. Time for the weekend. Nice week of work. Time for some relaxation, golf, good food, a little barbecue on Sunday. Can't wait. Don't have many hot topics for you today. There's lots of news, mind you, of course, as always. Don't like to rehash everything that's going on in every cable news show or every talk radio show. Pick out some highlights, something a little different. Now, we're only doing 15-minute podcasts, so can't fill in too much. As always, though, because I'm an econ fiend, I like to check in on the economy and markets. I do that on Mondays. We also complete little look backwards on Fridays. Let's check in on the economy and markets to start the show today. Why? Well, to track economic data in financial markets, you don't have to be an economist or a policymaker or a hedge fund manager or a banker. We have lots of financial risk out there in our daily lives as consumers, as workers, as savers, as investors, as entrepreneurs, risk takers. And so you always want to have a sense for the relative health of the economy around you and how markets respond to this data. What drives markets primarily is economic data, economic performance. Of course, headlines from politicians and central bankers and geopolitics matters. Of course, all kinds of things matter. But data really drives markets. And the reason why data really drives markets is because what we are trying to get down to every single day is, what does it mean for interest rates? What does it mean for Fed policy? And so we track the performance of the economy. Obviously, we have a little sense of what's happened in the recent past. And the recent past is the best predictor of our near future. We have a sense for where interest rates may be going. Consumers borrow, businesses invest. And we need to know this stuff. And then, of course, we need to know what's going on in markets because that impacts the price of goods and services, our retirement, our savings. Anyway, check in for this past week. We'll start on Monday. No data on Monday. On Tuesday, we had the Conference Board Consumer Confidence Index, 117 versus 111.8 expected, so much better than expected, and much higher than 110.1 from June. This was a July number. Headline confidence appears to have broken out of the sideways trend that has prevailed for much of the past year. Greater confidence was evident across all age groups and among both consumers earning income less than $50,000 and those making more than $100,000. Good news. We'll see if this is revised next month, but good news. And when we have a little inflection point in the data, we want to wait for a couple more data points to confirm if that inflection point is accurate and going to be sustainable in that direction. On Wednesday, as always, Wednesday morning, 7 a.m., MBA mortgage applications for the week ending July 21st, down 1.8% versus up 1.1% in the prior week. 30-year mortgage, 6.87% unchanged from the prior week. Also on Wednesday, June new home sales, down 2.5% to 697,000 versus 725,000 expected. And those are on an annualized basis, obviously. So lower than May, lower than expected. Not surprising. Homes are expensive. Interest rates are rising. Also on Wednesday, of course, in the afternoon, we had the 2 p.m. release of the FOMC decision on interest rates. The Federal Open Market Committee concluded their two-day meeting and decided to raise rates 25 basis points to 5.5%, as I told you they would. That's the federal funds rate, the overnight rate. Expecting them to pause now for a while, although they did not say they were going to deliberately pause, but that would be my prediction. I would think we had 2 or 3 or 4 meetings here without any rate changes, depending on what happens with inflation, of course. On Thursday, as always, at 8:30, we get initial unemployment claims for the week ending July 22nd, 221,000 versus 235,000 expected. Happy days. What a number. Against 228,000 the prior week. Something is a little screwy in our labor market data. Rising rates from 1% to 5.5%. War, inflation. Something's fugazi in the labor data, but it indicates a strong labor market still. And that, I guess, is good news. But we do know about this labor market for sure, as the jobs are of low quality in terms of pay. Many people working multiple part-time jobs in one household. So we're going to keep digging here. Each month, we get a little bit more suspicious about the labor market data. Doesn't quite line up with what you would think would be developing given the current economic environment we are really in. Also on Thursday, our first look at second quarter GDP, gross domestic product, up 2.4% versus 1.8% expected. Happy days, God bless America. And versus 2% in the first quarter. So good news there. This was mostly on the back of increases in private inventories. Now, that can be a good thing, increase in private inventories, when the economy is humming along, or it's an indication of businesses misjudging demand and therefore accumulating more inventory than expected. Inventories are part of gross domestic investment. And we had the price index out for the second quarter up 2.2% versus 3% expected and versus 4.1% in the first quarter. So, a good data point, but again, another data point leaving economists scratching their heads. Also on Thursday, June goods trade balance, minus $87.8 billion for the month versus $91.8 billion expected and versus $91.1 billion in May. So more bad news. China, big portion of that trade imbalance, of course. Another housing data point on Thursday, June pending home sales up 0.3% versus minus 0.5 expected versus minus 2.5 in May. So another decent housing number. Not bad. Pending home sales, those homes in contract waiting to go to closing. So the only risk there is someone doesn't get the mortgage they expected. And also Thursday afternoon, we got the Fed balance sheet, Federal Reserve's balance sheet, the assets they hold under management, $8.243 trillion. That's right, $8.243 trillion, down from 8.275 in the prior week. Holy cow. That's called monetization of federal debt. That's called saving the banks. That's called monetary policy mismanagement. On Friday, just one data point on Friday, Q2 employment cost index up 1% versus up 1.1% expected versus 1.2% in the Q1. Quick check on markets. S&P 500 opened the week at 4,556, at a high of 4,603, a low of 4,530. At the time of recording, we're at 4,579. I am not a supporter of putting new money to work up here. Keep a trailing stop. I think we have another leg down here in equities in the next few months. U.S. 10-year Treasury bond benchmark for the bond market opened at 3.85%, had a high on the week of 3.96%, a low on the week of 3.8%. At the time of recording, 3.97%. We have inversion of the yield curve, of course. The federal funds rate, the overnight rate is at 5.5%. Here, the 10-year is at 3.85%. So we have an inverted yield curve, usually a sign of recession. It's been inverted for a while, and somehow we're still getting positive growth. Something is a little askew. Check on oil, NYMEX WTI, opened the week at 76.94, had a high of 79.89, a low of 76.50, and now trading at time recording at 79.60. Not bad, given all the chaos going on with Ukraine and Russia still. Biden's efforts to clamp down on fossil fuel extraction, exploration here in the United States, not bad. I see gasoline is still in the mid $3 range in the Connecticut area. Checking on wheat, what happened with the Russia pulling out of the grain deal and attacking Ukrainian ports. Wheat opened the week at 709.75, had a high of 770.5, a low of 709.75, and now trading 696 and a quarter. So well off the highs there. Good news. Market reaction last week was swift, taking some profits. See how wheat holds up in the days ahead. And lastly, check on the foreign exchange market, the US dollar index. How's the old greenback doing against other currencies? Remember, everything in foreign exchange is relative, relatively weak, relatively strong. Opened the week at 101.30, had a high of 101.81, which means a stronger dollar, a low of 192, and now at the time of recording traded 101.49. So dollar, a little weakness in the dollar still compared to, say, the last few years. Remember, we went against the year, we went all the way down to 0.85 dollars per euro, and now we're trading around 109, 110. So still well within the relatively strong area, but nonetheless, as interest rates rise across the world and interest rate differentials shrink, we sell dollars and buy other currencies. That's all I have for you on markets and economy today. We'll have another check-in on Monday for the week ahead next week. Just a couple more things I want to talk to you about before I split for the weekend. The first hot topic I want to talk about is fighting. Seems to be a lot of fighting in public these days. Not sure if it's a result of cameras everywhere or just stressed out people at each other's throats. If you look at Reddit or watch YouTube videos, or just browse the news pages online, you see lots of indications of fights breaking out and lots of gang fights. By that, I mean multiple people beating up one person. The reason I bring this to your attention today is because there's another story in the New York Post today about another cab driver got beaten up pretty good. Don't know the cause yet. The pictures and video is on NewYorkPost.com. 5 people beat up a cab driver, apparently 60 years old. Remember, another cab driver was killed after being beaten to death in 2022. I guess what I'm after here to share is a couple things. First of all, when there's a fight, one of those persons does not want to be in the fight, especially if it's one person against 4 or 5 others or 2 or 3 others. However, if it's more than one-on-one, that one person doesn't want to be in the fight. If it's one-on-one, one of those people does not want to be in the fight. We should endeavor, whenever possible, whenever it's remotely plausible, to interfere and stop fights. Men, for sure. I think I've probably intervened to stop fights, I would say a dozen times in my life, easily. I lived in New York City for 17 years. I stopped many, many fights in the sidewalks. Risky move, no question. And of course, we know what happened to the Marine who tried to stop a crazed person on the subway a couple months ago and ended up killing the man. That's obviously a worst case scenario and something you have to be concerned about. People are concerned about the legal jeopardy of interfering in a fight. We should try to stop fights when we see them. Men in particular. You should try at least. I know it's scary, but it's probably best for society if we watch out for each other a little bit here. Don't need to know causality, and you don't want to get hurt yourself. So again, you got to make some quick judgments. Then the other thing I want to talk about is this horrible, horrible development. I think it's a development. It didn't seem to be this way when I was younger, closer to an age when I might be fighting. But the other thing that really bothers me is the stomping and kicking of people when they're down. When someone's down in a fight, that means you're winning. You're doing well. Doesn't mean you have to kick them in the face, kick them in the head, kick them anywhere. The kicking while you're down, that seems offsides. You know, I remind people whenever I talk to anyone about fighting, first to avoid fights, try to break up fights when you see them, but don't fall down, because that's where the real trouble comes in. A little diatribe on fighting today. All right, then lastly, I want to talk about our elected officials and appointed bureaucrats don't like to retire. If you're watching the news the past couple of days, you saw a video of Senate Minority Leader Mitch McConnell at a podium in Washington, D.C., frozen. A mental blackout. In the midst of his remarks, for about 20 seconds, he was frozen at the podium. His colleagues, after observing something was wrong, finally stepped forward and took his arms and kind of shook him back to reality. He reached out to get support from a stanchion, and then he was walked away from the podium and came back later and said everything was fine. He's not fine, obviously. Dianne Feinstein's not fine. President Biden's not fine. What is it about politicians, bureaucrats, that keep them working for so long? The average age of leading policymakers in the United States is like 72 and a half years old. President Joe Biden, 80 years old, first elected in 1907. Vice President Kamala Harris brings down the average here, 58, first elected in 2002. House Minority Leader Hakeem Jeffries, 52. Nice. Now we're getting to levels we like to see. First elected in 2007. House Minority Leader Kevin McCarthy, 58. First elected in 2000. Not bad. 50s, 60s, we're good. Senate Majority Leader Chuck Schumer, 72. First elected in 1974. Again, Mitch McConnell, Minority Leader, 81. First elected in 1977. Dianne Feinstein, 90 years old, Senator. Can't function. She was in the chamber, I think, yesterday. There was a roll call going on. She had no clue what was happening. She didn't know what she was doing. And someone next to her, you can hear it on the audio, just say aye. Sure enough, she just says aye. I don't know what they were voting on. Let's hope it wasn't anything serious. It might have been the National Defense Authorization Act. Federal Reserve Bank Chairman Jerome Powell, 70. First government job in 1990. Secretary of the Treasury Janet Yellen, 76. First government job in 1977. Secretary of Defense, 70 years old. What is going on? Power, status, fame, luxury, and fortune are powerful incentives to keep working into your 70s and 80s, apparently. Take out Harris and McCarthy, and the average age jumps up into 76. Seniority, network, name recognition, they rule in D.C. That's all I got for you today. Always try to buy American.